Did you know one candle can change your entire trading game? This exact strategy helped Rob Hoffman win 30 international trading competitions, beating the world's best. In this video, I'll show you exactly how this strategy works. It's built on 3 simple components: identifying the trend, spotting the candle correction bar, and applying it to the 1-minute, 5-minute, or 15-minute charts. With a high win rate and minimal risk, this strategy has the potential to drastically transform your trading results. But before we dive in, make sure to hit that subscribe button and turn on notifications so you don't miss out on more powerful trading strategies like this. Now, let's get started. The first condition of this strategy is identifying the trend. In trading, the market moves in 3 ways: an uptrend, where buyers are in control and push prices higher; a downtrend, where sellers take charge and drive prices lower; and a range-bound market, where price moves sideways in consolidation. For this strategy, our focus will be on the range-bound market, because that's where the magic happens. To break it down, when a trend moves horizontally, it eventually breaks out, either ascending or descending, forming an angular movement. This angle, typically around 45 degrees or more, is the hidden treasure we're after. For example, you might see a trend moving sideways before it suddenly drops, creating a sharp downward angle of 45 degrees. Or you may notice a horizontal trend that abruptly shifts upward, forming the same angle. These breakout angles are exactly what we're targeting. Now don't worry, this might sound complex, but I'm just explaining the logic behind it. We'll be using an indicator that identifies these angles automatically for us. Still, it's important to understand what's happening and why we're doing this. Let's see how this strategy works on a real chart, and I'll walk you through it step by step. First, look at this area. Can we say the trend is moving sideways or horizontal? Not at all. It's clearly going down, which means it's a downtrend, and we're not looking for trades here because this isn't the type of trend we need for this strategy. Now, check this section. The trend is moving sideways for a while and then it drops sharply, creating an angle of about 45 degrees. That's exactly what we're looking for. Let's find another example. Here, the trend moves sideways again, but this time it breaks upward, forming another 45-degree angle. Over here, we see the same thing: sideways movement followed by a sharp move upward at an angle of about 45 degrees. So here's the key. The first step is to find a sideways or horizontal trend. Then we wait for it to break out either up or down, forming an angle of around 45 degrees. This is where the opportunities are. But here's something important. Don't get fooled. Sometimes it might look like the trend is forming a 45-degree angle downward before reversing back up. To avoid this kind of confusion, Rob Hoffman recommends using a tool called the exponential moving average to get a clearer view of the trend. Let me show you how to add it. Go to your indicators, type EMA in the search bar, and select exponential moving average. In the settings, change the length to 20 and adjust the line thickness to make it easier to see. Now take a look. The 20 exponential moving average shows us exactly what's happening. In this section, the exponential moving average moves flat and then drops at a 45-degree angle. Over here, it moves flat and then shoots up at the same angle. In this area, the price moves sideways before rising again, forming another 45-degree angle. Even with the exponential moving average, we can sometimes get false signals, but don't worry, we'll use another more accurate tool later to confirm. For now, let's move to the second part of this strategy, the inventory retracement bar. This might sound a bit advanced, but don't worry, I'll break it down so it's easy to understand. What exactly is an inventory retracement bar? In advanced trading terms, it's a candlestick bar that opens and closes at least 45% away from its high or low. In simpler terms, the wick of the candle should be equal to or greater than 45% of the candle's total size. And here's an important point. The color of the candle doesn't matter. Whether it's red or green, the focus is on the wick size. Here's how it works. In a downtrend, look for candles with long lower wicks that are 45% or more of the candle size. In an uptrend, look for candles with long upper wicks that meet the same 45% rule. These candles indicate a potential opportunity for entry, but spotting them manually can be tricky, so we'll use a helpful indicator to make it easier. Let's see it in action. Look at this area on the chart. The trend moves sideways before breaking downward, forming a 45-degree angle. That's our first condition. Now just below this angle, we need to look for our inventory retracement candles. Here's one. This red candle has a long lower wick, making up at least 45% of its total size. This is a strong signal for a short position. Here's another one. A green candle with a long lower wick. And over here, there's another opportunity, and another one as well. The inventory retracement candles are all over this area, giving us multiple chances to enter a short trade. Now, to make things even easier, let's use the Hoffman Inventory Retracement Bar indicator. Here's how to add it. Open the Indicators menu and search for Hoffman. Select the Inventory Retracement Bar created by Uday. Once applied, you'll see green and red triangles on your chart. These triangles mark the inventory retracement candles for you. Green triangles signal a potential short entry. Red triangles signal a potential long entry. So, when the market breaks out of the range and forms a 45-degree angle, if the market moves downward after the breakout, you will consider the green triangles as potential sell opportunities. If the market moves upward after the breakout, you will consider the red triangles as potential buy signals. For example, look here. A green triangle appears on this candle, indicating a great opportunity for a short trade. As you can see, the trend has already moved downward after it. Let's find another one. This green triangle marks the perfect candle to enter. It's as simple as that. Even with the inventory retracement indicator, you might want more precision. That's where Hoffman's overlay indicator comes in. Here's how to set it up. First, we remove the 20 exponential moving average as we don't need it no more. Go to the indicator, search for Hoffman again and select Hoffman's overlay. Go into the settings and customize it. Remove unnecessary lines like the fast speed line and trend line 4. Simplify the display by adjusting the settings to focus on what matters. Now, here's how to use it effectively. There are two additional conditions to check. The green and purple lines on the overlay must be parallel, with no other lines between them. This confirms the trend is moving at a 45-degree angle. The target candles must be positioned correctly. In a downtrend, they should be below the purple line. In an uptrend, they should be above the purple line. For example, in this chart, the green and purple lines are parallel and there are no extra lines in between. The candles below the purple line confirm a downtrend, giving us a clear signal to enter a short trade. In an uptrend, it's the same concept but reversed. The candles must be above the purple line. Okay, look at this example. Here, we have this buy signal and this buy signal. Both worked, but we should avoid them. The reason is that there is a line between the green line and the purple line. When there is a line between them, the signal should be ignored because we are looking for a 45-degree formation. However, when the lines are parallel, like in this example, we can take this buy signal. Okay, now how do we trade this setup? Let's say you spot a range and then the market breaks below it and moves down. Here you can see that the purple line and the green line are parallel. Next, you spot this retracement bar, so you place your limit order 2 to 3 pips below the wick, with the stop loss either above the higher low or 10 pips above the candle. The target is always twice the risk taken. You can take this trade, and this one as well. This strategy is a trend-following strategy, which is why his creator won 30 trading competitions worldwide. Look at another example. Here, as you can see, the purple line and the green line are parallel, so you can take any opportunity that presents itself. You could enter here with the stop loss placed below the lower high. Another entry could be taken here with the stop at the low, and another entry there, again with the stop loss at the low. Finally, another entry here with the stop at the low. However, don't take too many trades at once. Only take the first trade and try to trail your stop loss. I showed these additional opportunities in case you open your chart and miss the earlier ones. If you took the first trade, use your stop loss and trail it until it eventually takes you out of the market. This is exactly how Rob Hoffman traded and won one trading competition after another. Okay, when it comes to stop loss and profit targets, it's up to you to manage them as you prefer. You can use trailing stops or a fixed stop loss, as explained earlier. For take profit, you can either use the next level as your profit target or trail the stop loss until you get taken out of the market. This is the best scalping tactic. Rob Hoffman explains that this strategy is highly effective because it capitalizes on the natural tendencies of the market. The market often moves in a way that sidelines most private traders. Here's what typically happens. During a downtrend, the market attempts to retrace slightly, creating the illusion that the trend is reversing. At this point, sellers exit the market, assuming the downtrend is over, while buyers enter, believing a new uptrend is beginning. However, the market then traps both groups, shaking them out before resuming its original downward direction. By adopting this strategy, you position yourself like a smart money trader rather than a retail trader, allowing you to capitalize on these predictable market movements instead of being misled by them. Alright guys, now it's your turn. Open your charts, add the indicators, and test this strategy for yourself. I want to hear your thoughts. Does it work for you? Have you noticed similar market behaviors? Drop your opinions in the comments below. If you found this video valuable, don't forget to like, subscribe, and turn on notifications so you never miss out on new trading insights. Also, check out my other videos for more proven strategies to help you trade smarter. Thanks for watching, and I'll see you in the next one.